Let me ask you something kind of uncomfortable. If the economy fell off a cliff tomorrow, markets tanking, headlines screaming, your neighbor panics selling everything he owns, how much of your money would actually survive? Be honest, not how much do you hope survives, how much would still be standing when the dust settles? Because here's something I've noticed about genuinely wealthy retirees. They don't sit there sweating every time the market hiccups. They're not refreshing their account at 2 a.m. with their stomach in knots. And it's not because they've got some secret crystal ball, it's because of what they own. They've quietly built their wealth out of stuff that's designed to take a punch and keep standing. While everybody else owns a portfolio that basically faints at the first sign of trouble, the wealthy own a portfolio that just shrugs. So today, we're going through the assets rich retirees use to protect their wealth over time, the building blocks that let them sleep like babies while everyone else is doom-scrolling financial news. And I want to be straight with you up front because this matters. There's no magic asset that's totally immune to bad times. What we're talking about today is resilience, stuff that has historically held up better than average when things get rough. Big difference. None of this is personalized advice. Always talk to a real professional for personalized financial advice. Let's dive in. Asset 1, boring cash. We're going to start with the asset everybody underrates, ignores, and actively makes fun of. I know, I can feel you reaching for the skip button. Maddie, cash earns nothing. Cash is for losers. My money should be working. And look, in good times, sure, sitting in a pile of cash isn't exciting. But here's what the wealthy understand that most people don't. Cash isn't supposed to make you money. Cash is supposed to save you. Here's the scenario that destroys retirements. The market drops 30%. And you, having no cash, are now forced to sell your investments while they're on fire just to pay your electric bill. You're selling at the absolute bottom, you're locking in losses, you're turning a temporary dip into a permanent disaster. That's the financial equivalent of throwing away your umbrella because it started raining. Now picture the wealthy retiree. They've got 1, 2, sometimes 3 years of living expenses just sitting in cash, boring, accessible, doing nothing. So when the market does its little tantrum, screaming, kicking, throwing itself on the floor, they don't have to sell a single thing. They just calmly pay their bills out of the cash bucket and wait. The market recovers, like it historically has, and they never touched their investments at the bottom. And here's the bonus. When everything's on sale during a downturn, guess who has the money to go shopping? The person with cash. Recessions are when cash quietly transforms from the lazy asset into the most powerful thing you own. While everyone else is forced to sell, the wealthy cash-rich retiree gets to buy. We're talking money market funds, short-term treasury bills, high-yield savings, short CDs, the unglamorous corner of finance. It won't make you rich, but it's the asset that keeps you from getting poor at the worst possible moment. Don't sleep on boring. Asset 2, high-quality bonds. And the king of the castle here is U.S. Treasuries. That's you lending money to the U.S. government, which is generally considered about as safe as it gets in the financial world. Here's why the wealthy love these, especially in retirement. Bonds tend to behave differently from stocks, and often when stocks are getting absolutely hammered, money comes flooding into treasuries because investors get scared and run towards safety. So bonds can actually hold their value or even go up exactly when your stocks are having their worst week of the decade. That's the magic. They zig when stocks zag. When you own both, the whole ride gets dramatically smoother. And smooth is exactly what you want when you're living off this money and can't afford a heart attack every time the news comes on. There's also a steady income angle. Bonds pay interest on a schedule. For a retiree, predictable income is gold. It's money coming in regularly that you can actually plan your life around instead of hoping the market is in a good mood this month. Asset 3, defensive stocks. Okay, but the wealthy don't just hide in cash and bonds. They still own stocks. They need the growth to outpace inflation over a long retirement. The trick is which stocks. And the defensive recession champions here are what we call defensive sectors. These are companies that sell stuff people buy regardless of how bad the economy gets. Think about your own life. When money gets tight, what do you cut first? The vacation, the new car, the fancy dinners. What do you not cut? Toothpaste, groceries, the electric bill, your prescriptions. You don't stop brushing your teeth because the economy's bad. That's the entire idea behind defensive stocks. 3 big buckets here. Consumer staples.
the companies making the everyday essentials, food, household products, the boring stuff that ends up in every single shopping cart in America, whether times are good or terrible. Their sales barely flinch in a downturn because demand is sticky. People will cut almost anything before they cut soap. Utilities, electricity, water, gas. You are going to keep the lights on in a recession. You're going to keep the heat running. These companies have remarkably steady demand because their product isn't optional. It's survival. And they tend to pay steady dividends too, which retirees love. Healthcare. People don't stop getting sick when the economy slows down. Demand for medicine, treatment, and care keeps right on going. It's one of the most recession-resilient areas of the entire market because biology doesn't care about the unemployment rate. These defensive names won't shoot to the moon when times are great. That's the trade-off. But they tend to fall less when times are bad. And for a retiree protecting wealth, falling less is the whole point. You're not trying to win the race. You're trying to finish it. Asset 4. Dividend-paying blue chips. Let me explain why this is such a powerful protection tool. A dividend is a slice of the company's profits paid directly to you, the shareholder, usually every quarter, just for owning the stock. Now, here's why this matters so much in a downturn. When the market drops, your share price goes down on paper. That's scary. But if that company keeps paying its dividend, you've still got income flowing in every quarter. And that income is the thing that keeps you from panic selling. You don't need to dump your shares at the bottom because you're still getting paid while you wait for the recovery. The dividend pays you to be patient, and patience is the most valuable trait an investor can have. The wealthy specifically hunt for the gold standard here. There's a group sometimes called the dividend aristocrats. These are large, established companies that have not just paid, but raised their dividend every single year for at least 25 years straight. Think about what that means. These companies kept increasing their payouts through recessions, through crashes, through all kinds of chaos. That's a serious track record of toughness. That's a company that has proven it can take a beating and keep delivering. The combo most go for is a big, profitable, financially sturdy company that throws off reliable, growing income. You get some growth, you get income that often rises faster than inflation, and you get the discipline of not having to sell when things look ugly. For a retiree, that's a beautiful trifecta. Quick reality check, though. No dividend is promised forever. Companies can cut them in genuinely bad times. So even here, the wealthy diversify across many dividend payers rather than betting everything on one company. Asset 5. Gold and precious metals. All right, let's talk about the shiny one, the asset humans have been obsessed with for literally thousands of years. Gold is what people often call a fear asset. When folks lose confidence in the markets, in the economy, in the value of paper money itself, they've historically run toward gold. So gold tends to do its thing when everything else is falling apart. It often moves independently from stocks, which makes it a useful diversifier. When your stocks are crying, gold sometimes isn't. It's also seen as a hedge against inflation and against currency losing its value over time. Gold can't be printed. A government can print more money. It cannot print more gold. That scarcity is a big part of the appeal, especially for people worried about their money slowly losing its purchasing power. But, and this is a big but, gold has real downsides, and the wealthy know them. Gold produces no income, zero. It doesn't pay you a dividend, it doesn't pay interest, it just sits there looking pretty. A bar of gold in a vault will never send you a check. It also can be surprisingly volatile, swinging around more than people expect. So, here's how the smart money actually uses it. As a small slice. We're usually talking a single-digit percentage of the portfolio. It's insurance, not a main course. It's the thing that helps when other things are hurting, but you'd never build your whole retirement on it.
Asset 6. Income-producing real estate. And I have to be really careful here because this is where people get themselves in trouble. Not all real estate protects your wealth. Some of it does the opposite in a recession. Let's draw the line clearly. The recession-resistant kind of real estate is income-producing property with steady, durable demand. The risky kind is speculative, heavily borrowed property where you're waiting on the price going up. In a downturn, that second kind can absolutely wreck you. So what are the wealthy actually like? Property that generates rent, because that rental income keeps flowing in and cushions the whole ride, even when the property's paper value dips. People always need a place to live. Housing in solid locations with real demand tends to hold up because shelter isn't optional. And you don't have to actually become a landlord fixing toilets at midnight to get this exposure. A lot of wealthy retirees use REITs, real estate investment trusts. That's basically a way to own a slice of large, professionally managed real estate portfolios that trade like a stock, and they're required to pay out most of their income to shareholders. The resilient REIT niches are the ones tied to needs, not wants. Healthcare facilities, grocery-anchored shopping centers because people keep buying groceries, certain types of housing, essential, boring, always in demand stuff. That's the pattern you keep seeing with everything the wealthy own, isn't it? Boring and essential beats exciting and optional every single time. The big lesson with real estate, the income is the protection. A property that pays you keeps you calm and keeps you solvent. A property you're just hoping appreciates is just a bet. Asset 7. Inflation-protected securities. This one's a little niche, but the wealthy love it, so let's cover it. Inflation-protected securities. In the US, these are called TIPS, Treasury Inflation-Protected Securities. Here's the problem they solve. There's a silent thief that robs retirees slowly over decades, and it's not a market crash, it's inflation. Rising prices quietly eat away at what your money can actually buy. $1 today simply won't buy as much in 20 years, and retirement can easily last 20, 25, 30 years. So even safe money can lose its power if it just sits there while prices climb. TIPS are government bonds specifically designed to fight this. Their value adjusts upward along with inflation, so when prices rise, these are built to rise with them, helping your money keep its purchasing power instead of slowly melting like an ice cube nobody's watching. For a retiree, that's a targeted little tool. It's the part of the portfolio specifically assigned to make sure inflation doesn't quietly hollow everything out from the inside. It's not flashy, it won't make you rich, but it plugs a very specific leak that sinks a lot of safe retirement plans. The wealthy think about every threat, including the slow, quiet ones that don't make headlines. Here is the uncomfortable truth. Everything we just talked about, all of that works beautifully if you're already wealthy life. So let's talk about why the same assets behave so differently depending on how much you've got. Reason 1. You can't diversify a small pie. Diversification is the whole secret, right? But try slicing a tiny pie into 8 pieces. Now each slice is a crumb. If your entire nest egg is small, splitting it across a bunch of asset types means each piece is too small to actually do anything. You can't buy a meaningful chunk of income real estate with crumbs. You can't build a cash cushion and a bond ladder and a stock portfolio when the whole pile barely covers a few years of groceries. The wealthy diversify because they have enough to spread. The poor retiree often has to keep everything in 1 or 2 simple things just to keep it accessible and safe. Reason 2, the cash cushion eats you alive. Remember how I praised the cash cushion? Here's the problem for everyone else. The wealthy retiree can hold 3 years of cash and it's maybe 5% of their money, no big deal. The struggling retiree holds 3 years of cash and it's half of everything they own. That's not a cushion anymore. That's a giant pile of your money sitting still, slowly losing ground to inflation while you desperately need that money to actually grow to last the rest of your life.
Reason 3. The game isn't protect, it's stretch. Here's the deepest difference, and it changes everything. The wealthy retiree is playing a game called protect. They've already won. They have more than enough. Their entire goal is to not screw it up, to defend the pile, avoid disasters, and coast. The poor retiree is playing a totally different game called stretch. They don't have enough, or they barely have enough, which means their problem isn't, how do I protect this? It's, how do I make this last, and ideally make it grow? And those 2 games call for almost opposite moves. Pure protection, all cash and ultra-safe bonds, might keep a small nest egg safe while it slowly shrinks to nothing under inflation and withdrawals. So the advice, play it safe, protect your wealth, can be genuinely harmful to someone who doesn't have enough wealth to protect yet. So here's my question for you. Drop it in the comments. Out of all these assets, which one do you own the least of? Which one were you completely sleeping on until right now? I'm genuinely curious. Let's talk about it down there. If this helped you think a little clearer about protecting what you've built, hit that like button and subscribe so the next one finds you.
And if you've got someone in your life heading toward retirement, send this their way. Future them will be grateful. Catch you in the next one. Protect your wealth, and it'll protect your peace of mind.